First, let me explain what are retracements. Retracements are short-term price corrections during an overall larger upward or downward trend. For example, imagine an uptrend going up. Then there is going to be a retracement, or also otherwise said a pullback, and then ideally the trend recovers and continues back up. Such retracement is a temporary price reversal. After the retracement exhausts its power, the pullback in an uptrend or the rally in a downtrend should stop, and the trend should continue in its original direction. During the retracement, the price can pull back or rally in a range of around 30 to 60%, which provides you with a great entry point where you can buy for a way lower price or sell for a way higher price, just before the continuation of the original trend. This strategy works best for short-term trades. If the retracement, though, crosses a certain line of a Fibonacci retracement level, it can be an indication of a complete trend reversal. How to recognize that I will tell you in a second, but let me first explain the psychology of this. Why does this happen? If we look at the psychology behind retracements, every single person entering a position will have a certain profit target in mind. Once this target has been reached, the person will sell the position and collect profit. This sell-off action will trigger a pullback in price if more people participate. The logical question now can be, how come that so many people at a certain price decide to sell? At this point, I would like to bring up something called the Thomas theorem. The Thomas theorem is a theory in sociology defined by William Isaac Thomas and Dorothy Swain Thomas. It says, if men define situations as real, they are real in their consequences. Or otherwise, how you interpret a certain situation causes a certain action. If a lot of people use Fibonacci retracements in combination with resistance and support lines and other indicators, a lot of people will answer to the same levels with a sell or a buy action. So even if it doesn't make logical sense, since many people rely on Fibonacci retracement levels, as a consequence of this collective thinking, they work like we expect them to work most of the times. The ideal use of the Fibonacci retracement levels is to buy in a pullback in an uptrend and sell at a rally in a downtrend. Now to the juicy stuff. How do we define where are the Fibonacci retracement levels so we can actually use them? Easy. Every single technical analysis portal is going to have the Fibonacci retracement tool. You don't have to calculate anything yourself. The tool is already there. Let's look together at tradingview.com and find an uptrend chart as our example. The only thing I'm going to do is that I'm going to choose from the tools the Fibonacci retracement tool, and I'm going to apply it on the chart of my choice. I look at the chart and I find the impulsive wave I want to measure. An impulsive wave is the clean upward move without any pullbacks in the trend. Now I need to find the lowest point and the highest point of this impulsive wave. When I do, I'm going to click at the lowest point of the impulsive wave, and I'm going to drag the Fibonacci tool all the way up to the highest point. Voila! All these lines have now appeared. Focus on 38.2%, 50%, and 61.8%. Because as we talked about the pullbacks in a trend, those retracements, those usually happen to around these three lines, most often to the 50% retracement. So once you see in an uptrend that a pullback is happening, which literally means a drop in price, you apply this tool and see if it's hitting one of these lines. Then you can use the momentum to buy into the trend. Preferable is to buy once you see that the pullback has stopped at one of these lines and is slowly bouncing back up. How? Easily. Within the pullback, you basically see a lot of red candles, and then you see that the last of the red candles stopped at one of these lines, and then you see a green confirmation candle. That's the moment when you buy. In a downtrend, when placing the retracement tool, your starting point is the highest point of the impulsive wave, and then you drag it to the lowest point of the wave where the new rally started. You see the price going up in the retracement rally, then you see that the price is hitting one of these points and can't get through. And then you see a red confirmation candle. This is the point when you sell. Approximately the best buy or sell zone within a pullback or a rally is around 32 to 50%, with a maximum of 62 to 66%. Under 66% in an uptrend or above 66% in a downtrend, there is a big danger of a whole trend reversal. As I said though, nothing is 100%, therefore you also have to set up your stop loss. Because if, for example, in an uptrend after the green confirmation candle, suddenly more red candles appear and the pullback of the retracement continued beyond the Fibonacci retracement levels, you should sell your position as soon as possible, because very probably this is no longer a retracement but a trend reversal. And since you have bought at the green confirmation candle, expecting the trend to move up again, you have to now as soon as possible sell to minimize your loss before it goes down even more. So now look at the chart. This is, for example, where I would place my stop loss. Very often it happens that the price retraces to as far as 65%, so my stop loss would be at around 68 to 70% retracement. So automatically, if it moves to that point, my position gets sold, because the risk of a trend reversal is too high, and I want to minimize my loss in case it does move even lower. Don't forget though that the Fibonacci retracement levels are not the only thing you should be using for your technical analysis. They can be wrong too. Be also mindful about volume, support and resistance lines, indicators, oscillators, and chart patterns. Hello everybody and welcome to the video about Fibonacci retracements. We're going to do now some screen sharing so I show you that Fibonacci retracements are actually not as hard as they may seem to many. So what you want to do with Fibonacci retracements is that you want to find a trend and then you want to find a rally or a pullback depending on which trend you are looking. So currently, for example, this is the one we're going to be using right now. We are looking at a downtrend. This is our downtrend. And because it's a downtrend, we are looking at rallies. Why are we looking at rallies? Because we are doing some day trading and we want to make money on these rallies. So you have a downtrend, which means that the price is decreasing. And then you have occasional rally, which is an occasional price increase. So what you want to do in these moments is that ideally you buy here and you sell at the top of the rally, and then you buy here and you sell at the top of the rally. But how do you know where the rally is going to stop and if it's even a rally or if it's a trend reversal? How can you recognize that? And that is when Fibonacci retracements come to play. So I have this beautiful trend and the only thing I do is that I click this particular area button right here and I click Fibonacci retracements, okay? And then I'm going to find my impulsive wave, which for me is going to be this one. And I don't know, we need to move it a little bit. And I'm going to click, because it's a downtrend, I'm going to click at the top of the impulsive wave and I'm going to drag it down to the lowest point. Now, if I now have just clicked and placed the Fibonacci retracement levels, we wouldn't see anything. So that is why you also like drag it, a bit to the right so it actually covers the rally. But like the point that I was, aiming to is this one. So this is now our impulsive wave and our rally. And you can see that the impulsive wave went all the way down, and then this rally started happening. And I started noticing it because obviously this is the area where I would buy some of that zebra stocks because I noticed this is a hammer, and I noticed that we're going to, by the way, explain to you also the single candlestick patterns. But simply said, this is where I would buy, and now I have to monitor how far the rally can go, okay? So I know that there is quite high volume and quite big candles here, so I know that this is very healthy and very strong growth. Now this candle would be for me first warning, but it was still on a quite heavy volume, so I'm like, okay, let's see where the next one goes. Next one was on a lower volume. That's an indicator for me to like, okay, we're slowing down. There is not much buy power anymore. And again, it was not a very strong move up or down. And also, it was the 6180 Fibonacci retracement level, which is like one of the most hit level in the Fibonacci retracement history. It really mostly stops at this level when it comes to rallies or pullbacks. So if I have placed the Fibonacci retracement levels, I'm like, okay, and it's totally hitting the 61.80. So there's a big chance if this is a rally and not a trend reversal, that now it's going to go down from here. Okay, that's why we're placing these levels, because 38, 20, 50, and 61.80 are those levels where these pullbacks and rallies stop the most. So I see that it did stop here. And for me, what I'm now looking for is what the next candle is going to look like and what is going to be the volume. Now, you see that there's actually very low volume on this particular candle. That is, for many people, this would not be their sell point. Okay, they would still be waiting, okay, wait, maybe we're actually reversing. But it did go slightly under the 61.8 level. And that is, this level is known for being hard, air quotes, hard to overcome. So at this point, already some would sell because they would recognize that this is actually the top of the rally. Some would be still waiting. But then, you see how this particular candle went. The volume got increased. Yes, it was an upward move, but started very low, and the price hasn't really moved, which is an indicator of the bulls. The bulls are, those people actually buying. They are losing at this point, okay? Because the price hasn't really moved, even though there was quite a big volume. And that is definitely plus this candle pattern as well. There is definitely an indicator of like rally over, sell immediately. And that's what you do. And then you see this candle, high volume, downward move, and then we just went down all the way. So that is why you're placing these retracements, because it does help you to determine where the rally is approximately going to stop. So again, this would be our impulsive wave. I'm going to click at the top, and I'm going to go with the lowest point, which was for me this point, okay? So you see, again, these three levels, most important. You see 38.20 approximately went actually over to around 44, this can be. So again, it's within these three levels. Now here at this point, I would still be waiting. I would not sell my assets because even though it's on a low volume, I like when it's hitting my lines. I wouldn't completely now sell at this point. I would still be waiting. But then you see that there was a big dump under, so approximately in this area I would already start selling because I would recognize, okay, rally is over, we're going down at this point. Even though the volume does not indicate like super high volume, the candle is too long for this low volume, which means that the bulls, the people buying, completely just lost, because if there is such a length in a candle on a low volume, it means that the bears, the people selling, are totally taken over. So for me already here, I would be selling, I would be taking my profit from the rally, okay? And so this is basically the only thing you do. You just click the tool and in a downtrend, you find the highest point of the impulsive wave, you drag it to the lowest point, then obviously you drag it a little bit to the right so you actually see the levels. and you check where the rally is approximately going to go based on these three levels, because you kind of count on, okay, it's going to go very probably to these three levels if it's a rally. So that's where it's probably going to stop. And if I see a red confirmation candle right next to it, like it's done and I can sell at this point. So you see that this rally went to 38.20. This would be actually a tricky one because you see that like right after it actually went approximately to the level of the low point. So this one would be actually a tricky one. But also the combination of these candles, which we will talk about after, would kind of warn you for sure. But that's why I'm always telling you, make a combination of indicators. Fibonacci retracements are not going to make it by themselves. So now we're looking at an uptrend. So let's do it in an uptrend. Okay, so this is our low point. This is our highest point, and we're going to drag it a little bit to the right. And you see again, this pullback, this is a pullback because we're talking about an uptrend, stopped at 38.20, and this particular candle definitely already would be an indicator of pullback is over, buy now. And you see that then it nicely went all the way up. Okay, but also, just so you know, you can make money like this within day trading, but this combination of candles, especially in this scenario, this is not a strong movement. Even though it went up quite a bit, you see like there was a fight, you know, the volume is not really high, and the price, like within a certain candle, the price hasn't really moved. So this is like a really tricky uptrend actually that is not considered very strong. This would be considered a weak uptrend because the fight is going on in every of these candles. And then you can actually see that the bulls really have won in a big way. You see that the price dropped a lot from this particular area because this, you know, was not a strong uptrend. It was bound to fail. And this is also what I'm going to explain to you, how to recognize that within chart patterns and actually single candlestick patterns. But we are here for the Fibonacci retracement. So this is how you use them. You just find an impulsive wave, you know, like this is a nice impulsive wave, for example, and you see where, and then you apply the Fibonacci retracement and you can see where a certain rally or pullback, this is a rally, is going to go. Okay, so these are Fibonacci retracements. I hope this was clear. And don't forget to combine these with support and resistance levels and indicators, oscillators, etc. because it will not do it by itself. Like for example, if you combine Fibonacci retracement and then you know that it's showing, like let's go to this one because this one was like pretty to show. So if I do the Fibonacci retracement here, right, and I see that it's hitting around the 44, and I also know that there is a resistance line right here from the past history of the chart. So for example, it seemed like it was a support. It seems like it used to be a support. So if you have drawn the line right here, then it could indicate that this was a past support, now turned resistance. So that again, you know, is an indicator for you like, okay, so this is the point where it could possibly stop.